Yeah, Cheryl, and arguably the second most important person in the Federal Reserve System, John Williams, thank you for joining us on this. You know, the first question I want to ask you is, you're looking at the market volatility over the past 14 days, but specifically yesterday and today, the futures are down again. Does that give you any pause then for possibly a rate cut again in May?
Well, first of all, welcome back, Ed, to the New York Fed. It's great to have you here. And, you know, right now, I look at where the economy is. The unemployment rate is 4.2%. Based on the latest data we have, it looks like inflation is running about 2.3%. And, you know, the economy has grew very nicely last year. So the economy is in a very good place. There's a lot of uncertainty out there about trade policy and other things. We are getting some information about that. But really, from my point of view, I think monetary policy is well positioned. I don't see any need to change the setting of the Fed funds rate anytime soon. And it's really about collecting information, understanding better what's happening in the economy during the rest of this year, understanding kind of how the uncertainty plays out and what it means for achievement of our maximum employment goals. But right now, I think monetary policy is in the right place.
But are you worried the Federal Reserve might fall behind in rate cutting cycle?
Well, I think that we have to look at all the data. You know, my view is, based on what we know about tariffs that have been announced and kind of are expected and their effects on the economy. I think we have a period of higher inflation this year and a slower growth path for this year relative to last year. So that's a combination that you have to think carefully about. What's the appropriate stance of policy? I obviously don't want to be late or in terms of any decision we make, but right now I think we've got policy in a good place and just got to collect that data and understand what's happening.
So with the rate cuts, the dot plot, the famed dot plot, projected 2 rate cuts. The markets are now saying or thinking there might be 4 of 25 basis points. Where are you? Has your outlook changed in terms of how many rate cuts should be this year?
Well, I think it's really hard to say because, first of all, there's just a lot of uncertainty about how the economy is going to play out this year. I think also, it really depends on how the economy responds in terms of whatever policies happen, and also how inflation is behaving, and importantly, how inflation expectations are behaving. I will put a little bit finer point on what the market expects. If you look at the Fed funds futures, yes, something like 3 to 4 rate cuts this year. But if you look at kind of where the modal outlook is from, we use options prices to do that. The market expects 1 to 2 rate cuts this year. That hasn't actually changed over the last few months. So I think, again, what we're seeing in market pricing is a reflection of the uncertainty about the economic outlook and what's going to happen in inflation. So my own view is I think that, again, we're going to have to watch the data, what it means for the outlook and the risks to that outlook. But, my basic views on where monetary policy is and should be haven't fundamentally changed.
You talk about inflation, CPI inflation, month over month actually decreased for the first time in 3 years, 0.1%. Does that put your mind at ease a little bit that maybe inflation is coming back down?
Well, it is. It's good news from the point of view of the kind of gradual decline in inflation we've seen over the last year or two. It's a sign that maybe the little bit higher readings we saw in the first 2 months were outliers, and we're still on a disinflationary trend. So I view that as good news. Still, we're above 2% inflation. We still have a ways to go on that. The bigger picture, of course, that's the rearview mirror. The bigger picture right now is how the various trade and other policies affect the inflation outlook.
The Fed chairman said that he could see a one-time price increase with tariffs coming in. Do you see the one-time price increase, and then could it come back down?
Well, I think that we will definitely get effects on prices and inflation this year from tariffs. That's what we've seen in the past. I think that's a pretty conventional view on how this will play out. I think the big unanswered question is, to what extent does the inflation remain high, say in 2026 or even longer? We need to make sure that any one-time changes in prices don't pass through into more persistent higher inflation. We need to get inflation back to 2%, after this period, and do that on a sustained basis.
And that sounds like a higher for longer in terms of rates.
Well, again, what the rate path is will depend on how the economy is behaving, what's happening in terms of our maximum employment and price stability goals. But it's absolutely essential that we keep inflation expectations anchored through this. That's a lesson from history. It's something that's really paid dividends in the past, and that's really, quite honestly, where I'm focused.
Goldman Sachs raised the chance of a recession to 35%. will we see a recession in the next 12 months?
Well, I'm not going to make a prediction around recessions or anything like that, because our objective is objectives for maximum employment, price stability. So of course, private sector economists, are asked those questions a lot. I'm more focused on what's the outlook for the economy, what are some of the risks to that, and how do we get monetary policy positioned. So I definitely have a view that growth this year is going to be significantly slower than last year, probably somewhat below 1% GDP growth for the year, and unemployment will come up to about 4.5% to 5%. So it is a slower economic outlook. That's not a recession. That's just a slower outlook, slower growth than we've seen in the past couple of years.
What are your CEO contacts telling you in terms of uncertainty? Are they still nervous about going forward?
No, absolutely. I talk to business leaders, from small businesses, medium businesses, and global businesses. Uncertainty, and especially uncertainty around tariffs and trade policy, is the number one topic. It's very difficult if you're a business to make long-term decisions on investment, new products, and things like that when you're not quite sure what the environment will look like. And for the U.S. economy, which is obviously very connected to the global economy and the global financial system, what I'm hearing is it's people kind of pausing on big business decisions and investment, waiting to see how this plays out, and trying to figure out how to be successful, once we have that clarity.
In the last 30 seconds we have, the neutral rate, has it fallen according to the Fed? Has R star come down?
Well, according to the Fed, I can't speak to that, but right now my estimates that I do say the neutral rate is still relatively low. If you ask me about some of the changes we've seen in terms of the longer run growth prospects for the economy through immigration changes and other changes, I would think if anything those are kind of keeping downward pressure on the neutral rate. My view is it hasn't. I don't have any evidence it's changed.
And where do you see the federal funds rate landing? Where is the bottom for you?
Well, my own view, in terms of in the long run,
yes.
My view is with the 2% inflation, which we'll get back to, and then view of the longer run kind of neutral real rate is probably somewhere around 0.75% or some plus or minus that. So we're talking about a Fed funds rate around 3% or a little bit less. That's just my view, but it could change.
John Williams, thank you very much for your time. I appreciate it. Cheryl, we're going to send it back to you. Interesting times now, a lot to chew on here, and the market's obviously showing a little bit of red today. Back
Absolutely. Yeah, Edward, thank you so much for that great interview. Edward Lawrence